Hi guys! Enjoy John's analysis.
Yesterday, you were scared. Today, you are in a different psychological state entirely. And if you do not understand the difference between those two states before you make any decision about your Bitcoin position, you are going to do something today that you will spend the next 3 years trying to explain to yourself. Here is where we are right now, on the morning of June 5th, 2026. Bitcoin is trading at $60,200. Down 51% from its all-time high of $126,198, set on October 6th, 2025. The Fear and Greed Index is at 12. The RSI on the daily chart has collapsed to 16.95, one of the most oversold readings in the history of this cycle. $1.1 billion in leveraged long positions were force liquidated in the last 24 hours. 272,000 traders wiped out in a single session. 11 consecutive days of net outflows from U.S. spot Bitcoin ETFs. This morning, the U.S. Bureau of Labor Statistics reported 172,000 new non-farm payrolls in May, nearly double the 85,000 that economists expected, which destroyed any remaining probability of Federal Reserve rate cuts before 2027. And overnight, Hezbollah rejected Israel's ceasefire offer, sending geopolitical risk across every risk asset simultaneously. This is not the same market you watched yesterday. This is the market after a cascade. After a flush. After 272,000 leveraged traders lost everything they had in their positions in a single day, and the wreckage of those positions hit every order book on every exchange at the same time. And the question you're sitting with right now is not the same question you had yesterday. Yesterday, the question was, should I sell? Today, the question is this the beginning of the end? Or is this the end of the beginning? Those two questions have completely different answers. And the data, not the fear, not the panic, not the headlines, the actual verified on-chain data, makes that distinction with more clarity than most people in this market are capable of seeing right now. Because most people in this market right now cannot see anything except red. I'm going to show you exactly what created the bloodbath you are watching. I'm going to show you the precise mechanical reason why $1.1 billion in positions were destroyed in 24 hours, and why that mechanism is not what you think it is. I am going to show you what the Onchain structure says about where we actually are in this cycle, and I am going to run the exact 4-signal protocol check, live, in front of you, using today's numbers, that tells you whether the data supports selling or holding. Then I'm going to let you decide. Drop a comment right now. 1 sentence. Tell me what is happening in your head at this exact moment. Not what the market is doing, what is happening in your head. Because at the end of this video, I'm going to come back to that comment and tell you something about it that will either confirm your decision or completely change it. Stay until the end. Before we talk about what this means, you need to understand what actually created the bloodbath you're watching. Because the story the headlines are telling you is not the complete story. And the incomplete story is going to cost you money if you act on it. Here's the mechanical reality of what happened between June 2nd and June 5th, 2026. Bitcoin was trading near $71,765 on the morning of June 2nd. Leverage across the Bitcoin derivatives market had climbed to levels last seen directly before the October 2025 crash. Open interest was elevated. Perpetual funding rates were mildly positive, meaning the market was leaning long, crowded, fragile, sitting on top of millions of dollars in liquidation thresholds stacked at regular intervals below the current price, like landmines waiting for the ground to shift. On June 2nd, the ground shifted. Bitcoin crossed below the psychologically significant $70,000 level. That breach triggered the first wave of forced liquidations. Exchange algorithms do not wait for human confirmation. They do not weigh context. They see a position breach its maintenance margin threshold and they close it immediately, selling into a market that is already falling. That forced selling pushed the price lower. Lower prices hit the next layer of liquidation thresholds. Those positions were closed, adding more forced selling. That selling hit the next layer, and the next, and the next. On June 2nd, roughly $394 million in leveraged positions were force closed in a single hour. Not because of a fundamental change in Bitcoin's value, not because an exchange collapsed, not because a government banned the asset, because the market was over-leveraged, a price level was breached, and an automated chain reaction did exactly what automated chain reactions do when they encounter a leveraged market stacked with liquidation points. By June 4th, the total damage was $1.8 billion in forced liquidations across the broader crypto derivatives market, with Bitcoin leading at approximately $486 million of that total. 272,000 traders had their positions closed against their will. Bitcoin futures open interest declined 4.55% to $51.37 billion, $2.45 billion of leverage flushed from the market in days. Here is what the financial press is not telling you about that number. The liquidation cascade was, mechanically, a reset. It cleared out the crowded long leverage that made the market fragile in the first place. Analysis published June 4th noted that falling open interest alongside weaker price action indicates leverage being flushed, a sign of de-risking rather than capitulation-driven structural collapse. Perpetual funding rates remained mildly positive, not at the extreme overheated levels that precede further squeeze events. The leverage overhang that was making the market vulnerable to exactly this kind of cascade has now been substantially cleared. And there is something else the headlines are not showing you. Data published June 3rd shows that over $10 billion in short positions are now stacked between current prices and the $80,000 resistance level. Every single one of those short positions is a forced buyer if the market moves against them. The same mechanism that created the liquidation cascade on the way down, forced position closure adding directional momentum, exists in full force on the way up. The market that looks broken from the outside has just loaded significant squeeze potential into the structure above current prices. The 5 converging catalysts that hit simultaneously were these: 11 consecutive days of ETF outflows representing the longest streak in ETF history. Strategy's symbolic 32 Bitcoin sale treated by sentiment as a capitulation signal. $739 million in Mt. Gox's wallet movements creating distribution fear. Geopolitical risk-off from Middle East escalation. And the gravitational pull of an equity IPO supercycle, draining liquidity from speculative assets as institutional capital rotated toward AI infrastructure. None of these 5 factors, individually, was sufficient to produce a cascade. Together, they provided the spark for a market that had been building leverage to dangerous levels for weeks. The cascade you watched was not a signal that Bitcoin is finished. It was a mechanical event created by leverage concentration, triggered by converging macro catalysts, and amplified by automated systems. Every prior major liquidation cascade in Bitcoin's history, March 2020, May 2021, November 2022, was followed within weeks or months by a recovery as the leverage overhang cleared and conviction capital re-entered at lower prices. The question is not what caused the cascade. The question is what the underlying structure looks like now that the cascade has cleared. And for that, you need to stop looking at the price chart and start looking at the data. You held yesterday. The price was $67,000. The fear and greed index was 11. Everything felt terrible. And you held. Today, the price is $60,200. The fear and greed index is 12. Everything feels catastrophically terrible. And you are closer to selling than you were yesterday. I want you to sit with that for a moment. Because what just happened in your decision-making process is the most expensive cognitive error in investing, and it is happening to you right now, in real time. Daniel Kahneman spent 40 years studying exactly this. His prospect theory, published in Econometrica in 1979 and foundational to his Nobel Prize in 2002, established that human beings do not evaluate financial decisions against objective baselines. They evaluate them against reference points, and the reference point shifts with recent experience. Yesterday, your reference point was $126,000. The gap from $126,000 to $67,000 felt like a 53% loss, enormous, unbearable, but survivable, because you had held through it for weeks and it felt like old pain. Today, your reference point has partially shifted. Part of your brain is measuring from $67,000. The $7,000 decline since yesterday is being processed as a new, fresh loss, separate from the 53% you already absorbed. It is adding weight to an already exhausted psychological position. The urgency to act is higher today than it was yesterday, even though the fundamental case for holding has not changed by a single data point. The only thing that has changed is the number on your screen and the length of time you have been watching it fall. Kahneman demonstrated the loss aversion mechanism with a simple experiment that has been replicated across every culture and wealth level where it has been tested. He offered successful executives a coin flip proposition where tails cost $10,000. Every participant required a potential gain of at least $20,000 to accept the bet. The pain of potential loss was twice as powerful as the pleasure of potential gain, not because these were irrational people, but because loss aversion is a hardwired feature of human cognition evolved over hundreds of thousands of years. It is genuinely useful when a predator is chasing you. It is systematically destructive when applied to long-duration asset holding, because it causes you to sell at exactly the moment the data says you should be holding. Recency bias amplifies it. During every Bitcoin bear market without exception, the dominant narrative at the bottom is that the bear market will continue indefinitely. Investors extrapolate recent price performance into the future, creating maximum pessimism at exactly the moment prices are lowest. The fear and greed index at 12 is not a signal that the market is broken. It is a signal that maximum pessimism has been reached. and maximum pessimism, documented across every prior Bitcoin cycle, has not been a signal to sell. It has been the signal that historically preceded the largest subsequent price gains. The Kraken FOMO and FUD survey, conducted across 1,248 crypto holders in October 2024, found that 81% of holders have made decisions based on fear, uncertainty, and doubt. 63% reported those decisions negatively impacted their portfolio. Not decisions made at cycle tops when caution was warranted, decisions made in exactly the psychological state you are in right now. After an extended drawdown, after a sudden acceleration lower, after a cascade event that made everything feel final, here's the question that cuts through all of it. What did the data say at every prior moment that felt exactly like what you're feeling right now? Let us go through the historical record, not the cleaned up version with comfortable hindsight, the actual experience of being a holder at every prior moment that felt like what you're feeling right now. 2011. Bitcoin fell 93.8% from $31.91 to $1.99 over 163 days. The crash was triggered by the Mt. Gox hack. 850,000 Bitcoin stolen, the dominant exchange compromised, the security model of the entire network in question. The technical community did not debate whether Bitcoin would recover. They debated whether the network could survive at all. The sentiment was not fear. It was grief. The asset appeared to be dead. Selling was not emotional. Selling was rational. The experiment was over. Every serious person in the space agreed. What happened to the holders who did not sell? Bitcoin recovered from $1.99 to $1,163 within 24 months, 584 times the bottom price. The security problem that justified selling was solved. The network survived. The narrative of permanent death was wrong. 2013 to 2015. Bitcoin fell 86.9% from $1,163 to $152 over 410 days. 3 simultaneous catastrophic events converged. China banned financial institutions from handling Bitcoin. Mt. Gox filed for bankruptcy, revealing 850,000 Bitcoin lost, roughly 7% of all Bitcoin in existence. And the FBI shutdown of Silk Road permanently associated the asset with criminal markets. The combination of regulatory hostility, exchange collapse, and criminal association created a narrative of permanent, irreversible contamination. Serious mainstream financial analysts said the asset would never recover legitimacy. They were unanimous. What happened to the holders who did not sell? Bitcoin recovered from $152 to $19,891 within 3 years, 130 times the bottom price. Every regulatory nightmare that justified selling proved temporary. China's ban was eventually reversed. The exchange collapse created the demand for regulated custody solutions that enabled the ETF era a decade later, 2018. Bitcoin fell 84% from $19,891 to $3,122 over 363 days. The ICO bubble collapsed under SEC enforcement. Mainstream retail investors who had bought near the top during the late 2017 media saturation were devastated. Institutional adoption was described by the most respected voices in finance as a fantasy. The asset had no fundamental value. These were not fringe opinions. They were the consensus of analysts who had been right about other markets. What happened to the holders who did not sell? Bitcoin recovered to $69,000 within 3 years, a 22 times gain from the bottom. The institutional adoption that was unanimously called a fantasy produced the ETF approvals of 2024. The infrastructure that now holds over $365 billion in regulated ETF assets. March 2020. Bitcoin fell 63% in 30 days, including 52% in 48 hours, as global markets liquidated everything simultaneously in response to the COVID pandemic. The narrative was immediate and powerful. Bitcoin had failed as a safe haven. It was just another risk asset, and a global recession would eliminate speculative demand permanently. The speed was unlike any prior crash. It felt like a complete structural failure happening in real time. What happened to the holders who did not sell? Bitcoin recovered from $3,782 to $69,000 within 20 months, an 18 times gain from the bottom. The COVID crash that felt like the end became the entry point that produced generational wealth for the holders who stayed through the panic. 2022, the FTX collapse. Bitcoin fell 77.6% from $69,000 to $15,476 over approximately 14 months. The FTX collapse, the largest fraud in crypto history, destroyed institutional credibility overnight. Sam Bankman-Fried had been the public face of responsible crypto to regulators. His arrest made the entire industry look fraudulent by association. Regulatory action was described as existential. The dream was not paused, it was over. This time, serious institutional voices agreed there was no path back. What happened to the holders who did not sell? Bitcoin recovered from $15,476 to $126,198, 815% from the bottom. BlackRock, Fidelity, and CalPERS entered the market. The same regulatory framework that seemed existential after FTX produced the ETF approvals that brought institutional capital at scale. The pattern nobody mentions when you are about to sell. Look at those 5 moments again. Each one had a narrative that made selling feel completely rational. Not emotional, not weak, logically justified by specific, real, documented events. The Mt. Gox hack was real. The China ban was real. The FTX fraud was real. The COVID recession fear was real. The SEC crackdowns were real. And, in every single case, the holder who treated the real event as a permanent conclusion rather than a cyclical disruption was wrong. Not sometimes wrong, every single time wrong. Every documented seller at every major Bitcoin cycle bottom has either publicly expressed regret or permanently exited an asset that subsequently recovered to new all-time highs. That is not opinion. That is the complete historical record. The current catalysts are real. The question is whether they represent permanent structural change or a cyclical disruption of exactly the kind that has preceded every prior major recovery in this asset's 15-year history. Before we get into the on-chain data, 30 seconds. Everything we are about to cover, the signal framework, the historical cycle analysis, the protocol that tells you when the data actually justifies action, is documented in full in the Bitcoin Holder's Bible, not as theory, as a practical decision framework. A 5-minute weekly check that converts the signals I'm about to walk through into one clear answer: action or no action. The retail price is $97. Stay until the very end of this video and I will give you a $50 voucher. Your copy, $47. Stay with me. This is the section that people who are about to sell are not watching. They are watching price charts and reading liquidation headlines. What I am about to walk through is the data that has, without exception, across 4 complete Bitcoin market cycles, identified where the market actually sits structurally, as opposed to where it feels like it sits emotionally. MVRV Z-score. The market value to realized value Z-score compares Bitcoin's market capitalization to its realized capitalization. What the market values Bitcoin at versus what holders collectively paid for it. When the Z-score exceeds 6 or 7, the market is historically overextended. Cycle tops have formed at these levels in 2013, 2017, and 2021. When the Z-score approaches 0 or goes negative, the market is at or near aggregate cost basis, the deepest accumulation territory that has historically preceded the largest subsequent rallies. Current reading, approximately 0.41. The October 2025 all-time high at $126,000 produced an MVRV Z-score of only 1.73, already well below the overheated zone. The 2021 peak produced a reading of approximately 5.9. The 2017 peak produced a reading of 8.2. At 0.41 today, the MVRV Z-score is at roughly 1/10 of the valuation level that has historically defined cycle tops. If you are selling because you believe Bitcoin is overvalued and about to collapse from an extended top, the MVRV Z-score does not support that thesis. The overheated readings that have historically justified selling are at 6 to 7. We are at 0.41. UPL, net unrealized profit and loss. NUPL measures the aggregate ratio of unrealized gains to losses across the entire Bitcoin network. Above 0.75 is the euphoria zone, where cycle tops have historically formed. The November 2021 peak saw NUPL enter euphoria territory at approximately 0.75, flagging the top before the 77% decline that followed. Below 0.25 is the capitulation zone, the territory that has historically marked cycle bottoms. Current reading, approximately 0.28, at the boundary of capitulation territory, not in euphoria, not in the distribution zone, in the zone that has, in every prior cycle, characterized the maximum accumulation window before the next phase of the market begins. NUPL below 0.25 is one of the 4 conditions that have historically identified confirmed cycle bottoms with the highest statistical reliability. The other 3 are MVRV Z-score below 1, LTH SOPR below 1.0, and elevated RHODL ratio. 3 of those 4 conditions are currently met simultaneously for only the 4th time in Bitcoin's 15-year history. LTH SOPR, long-term holder. Spent output, profit ratio. LTH SOPR measures whether Bitcoin moved on-chain by holders who have held for more than 155 days was sold at a profit or at a loss. A reading below 1.0 means even the most conviction-oriented segment of the market is realizing losses. Capitulation. Current reading, approximately 0.819. For context, the November 2022 cycle, bottom at $15,476, saw LTH SOPR drop to approximately 0.67. The December 2018 bottom at $3,122 saw it at approximately 0.80. The current reading of 0.819 is approaching the extreme capitulation levels of prior confirmed bottoms. This tells you two things. First, genuine structural pain is present. This is not a healthy mid-cycle pullback. Second, based on historical precedent, you may be in the final stages of a capitulation process, meaning the worst of the pain may be close to exhausting itself rather than just starting. RHO-deal ratio and long-term holder supply. The RHO-deal ratio measures the balance between conviction capital, coins held for 1 to 2 years, and speculative capital, coins held for 1 week or less. A high reading means old coins are sitting still, speculative sellers have exited, and the holder base is dominated by conviction capital. Data published June 3rd shows long-term holder supply has increased by over 400,000 Bitcoin since February, with long-term holder assets up $15 billion year to date. The only comparable RHO-deal readings in the metric's history occurred at the confirmed cycle bottoms of late 2015 and late 2022. Both preceded sustained multi-year bull markets within 18 months. The realized price floor, the Bitcoin network's realized price, the aggregate average cost basis of all coins on the network, currently sits at approximately $56,200. At $60,200 today, the entire network is sitting on thin but positive aggregate unrealized profit. The last time Bitcoin's price fell below the realized price was in early 2023. A fall to the realized price from current levels would represent an additional decline of approximately 7%. Painful, but not catastrophic, for a holder with a multi-year horizon. These are the levels where, in every prior cycle, long-term buyers have historically absorbed supply most aggressively. The 5-metric convergence. Onchain analysis published in May 2026 documented a critical finding. The first and second quarter of 2026 represents only the 4th time in Bitcoin's 15-year history that 5 of 7 core glassnode metrics simultaneously flagged bottom formation behavior. The 3 prior instances, late 2015, late 2018, and mid-2022, each preceded rallies of 300% or more within 18 months. We are in the 4th such convergence. This does not mean Bitcoin cannot go lower. It can. What it means is that the on-chain structure is not consistent with a cycle top followed by an extended bear market. It is consistent with a drawdown in the late stages of a capitulation process. Painful, real, and historically followed by a recovery to new all-time highs. Words are cheap. Let us look at capital flows, what the institutions with the most sophisticated Bitcoin analysis on the planet are doing with their money right now. Strategy, formerly MicroStrategy, holds over 815,000 Bitcoin. During the first 4 months of 2026, as the market debated whether the bear market had returned, Strategy accumulated approximately 80,000 Bitcoin at prices between $62,000 and $78,000. In April 2026, the company purchased 34,164 Bitcoin at an average price of $74,395 per coin. The company's most recent filing confirmed a sale of 32 Bitcoin, 0.0038% of its holdings, to fund a dividend obligation. That 32 coin sale generated more market panic than 80,000 coins of accumulation generated confidence. That asymmetry is the fear mechanism operating in real time. Strategy is accumulating at the prices where you are considering selling. Kai-Young Ju, founder and CEO of CryptoQuant, noted on June 4th that since Bitcoin was around $63,000 in March 2024, ETFs have absorbed 509,000 Bitcoin in Strategy, bought 650,000 Bitcoin, meaning approximately 1.24 million Bitcoin was absorbed by institutional buyers, while the price returned to the same level. That is not abandonment. That is institutional accumulation at scale using price weakness as an entry mechanism. BlackRock's IBIT currently holds over 572,000 Bitcoin, approximately 2.7% of Bitcoin's total fixed supply. In the first quarter of 2026, IBIT saw net inflows on 48 of 62 trading days, drawing $8.4 billion in new institutional capital as Bitcoin's price fell. Total ETF balances sit at approximately 1.27 million Bitcoin, 6.4% of total supply, approximately $82 billion, just 7% below their peak. Structural institutional ownership through regulated vehicles has not been materially unwound. Institutional investors now claim 38% of total spot Bitcoin ETF assets, up from 24% just 1 year ago. These are pension funds, endowments, and sovereign wealth funds allocating on multi-year frameworks. They are not selling, they are buying the dip you are selling. Fact 1. Bitcoin has experienced 4 declines exceeding 77% in its history and has recovered from every single one to set new all-time highs. The current decline of 51%, while painful, is not historically anomalous. It is not even historically severe by Bitcoin standards. Every prior decline that felt permanent was not. Fact 2. The MVRV-Z score at approximately 0.41 is 1/10 of the overheated readings that have historically preceded major cycle tops. Sellers who believed they were avoiding a collapse at every prior top had MVRV-Z score readings between 4 and 8 to justify that concern. The current reading of 0.41 does not provide that justification. Fact 3. The LTH SOPR at 0.819 is approaching, but has not yet reached the capitulation extremes that have historically marked definitive cycle bottoms. Selling before capitulation completes has historically been the most expensive timing error in Bitcoin investing. You are potentially selling in the final stages of the pain, not before it begins. Fact 4. Long-term holder supply has increased by over 400,000 Bitcoin since February 2026, with long-term holder assets up $15 billion year to date. The people with the longest time horizons and the deepest on-chain expertise are accumulating, not distributing, through this drawdown. Fact 5. The minimum post-bear market rally following a 70+% Bitcoin decline since 2013 has been 101%. The average has been dramatically higher. Buy at the 2015 bottom at $152 and hold to the 2017 peak, 130-fold return. Buy at the 2018 bottom at $3,122 and hold to the 2021 peak, 22-fold return. Buy at the 2022 bottom at $15,476 and hold to the 2025 peak, 8-fold return. The seller who exits at current prices and waits for confirmation of the new bull market typically re-enters after 50 to 150% of the move has already occurred. Fact 6. Strategy purchased 34,164 Bitcoin between April 13th and April 19th, 2026, at an average price of $74,395 per coin, while you're considering selling at $60,200. The company that has accumulated more Bitcoin than any other entity on Earth was buying the dip you are selling. Fact 7. The 4-metric on-chain convergence, UPL near capitulation, MVRV ZIT score at fair value, LTH SOPR below 1, RODL elevated, has occurred only 3 prior times in Bitcoin's history: late 2015, late 2018, mid-2022, all 3 preceded rallies of 300% or more within 18 months. We are in the 4th occurrence. Fact 8. The fear and greed. Index at 12 represents maximum pessimism, which has historically been a contrarian accumulation signal, not a sell signal. RSI readings below 20 on the daily chart have coincided with many previous bottoming regions across multiple cycles. The most oversold conditions have historically preceded the sharpest subsequent recoveries. Fact 9. Over $10 billion in short positions are now stacked between current prices and the $80,000 resistance level. Those short positions are forced buyers if the market recovers. The leverage cascade that hurt you on the way down has preloaded a potential accelerant on the way up. Fact 10. Every seller at a major Bitcoin cycle bottom who has publicly documented the decision has expressed regret, without exception, across every cycle from 2011 to 2022. This is not a sample. It is the complete historical record. The behavioral finance literature is equally unambiguous. Investors systematically sell near bottoms, not near tops. You are about to add your decision to that statistic, or decide not to. I'm not going to give you a one-sided presentation. The bear case has real components that deserve honest acknowledgement. And if you're going to make an informed decision, you need to hear them clearly. The macro environment. This morning's jobs report, 172,000 new non-farm payrolls against an 85,000 expectation, confirms the U.S. labor market is not softening at the pace required for the Federal Reserve to justify rate cuts before 2027. That removes one of the primary catalysts Bitcoin bulls had been pointing to for the second half of 2026. Higher risk-free yields directly compete with non-yielding assets. U.S. CPI remains above the 2% target. The Strait of Hormuz tension is keeping oil above $93. Hezbollah's rejection of the ceasefire overnight adds another layer of geopolitical risk to a market that was already risk-off. These are not invented concerns. The demand contraction signal? CryptoQuant head of research. Julio Moreno flagged this week that Bitcoin demand is contracting at a pace comparable to the post-Terra and Luna collapse period of 2022. CryptoQuant also flagged a 232,000 Bitcoin monthly demand contraction. And demand contractions are structurally different from leverage flushes. A leverage flush clears in hours once over-leveraged positions are closed. Demand contraction can persist for months. If demand does not return, price recovery is deferred, potentially significantly. This is the most legitimate structural concern in the current bear case. The cycle timing argument. Based on historical halving cycles, peak to trough duration has averaged approximately 383 days. The October 2025 all-time high was approximately 240 days ago. Historical patterns suggest the bottom may not arrive until the third or fourth quarter of 2026. Veteran trader Peter Brandt projected in March 2026 that Bitcoin would not reach a new all-time high before the second quarter of 2027, and suggested a possible retest of $60,000, which has now occurred. The current price of $60,200 may not be the final low. The honest assessment. The scenario where selling today proves correct over a 1 to 3 month horizon carries a probability the structural data places in the range of 30 to 40%. It is a real possibility that deserves acknowledgement, not dismissal. The scenario where selling today proves correct over a 3 to 5 year horizon, where Bitcoin does not recover to current prices, let alone new all-time highs, requires a coordinated global regulatory ban, a cryptographic failure in the SHA-256 hash function underlying Bitcoin security, or the complete and permanent unwinding of the $365 billion in ETF infrastructure. The data assigns that scenario a probability below 5%. You are not making a decision about the next 30 days. You are making a decision about the next 3 years. And on that question, the historical record across 5 complete bear markets, each with its own convincing narrative for permanent impairment, is unambiguous. Now we run the protocol, not on feelings, not on headlines, on the 4 signals that have historically defined when selling Bitcoin is justified by data rather than emotion. Signal 1, NUPL above 0.65? No. Current reading 0.28. The distribution threshold is 0.65. We are approaching capitulation territory, not distribution. Signal not triggered. Signal 2, LTH distribution rate above $500 million per day? No. LTH SOPR at 0.819 indicates long-term holders moving coins are realizing losses. Capitulation behavior, not the profitable distribution that precedes cycle tops. Signal not triggered. Signal 3, MVRV Z-score approaching 6 or 7? No. Current reading 0.41. Distribution alert begins at approximately 2, escalates at 4, has historically coincided with cycle tops at 6 to 7. At 0.41, we are at roughly 1/10 of the level where concern becomes justified. Signal not triggered. Signal 4, SECI sells signal generated. The stablecoin cycle composite index fired on September 22, 2025, 14 days before the all-time high at $126,000. That signal has not been regenerated, not active. Protocol answer, 0 of 4 distribution triggers activated, 0. If you came into this video believing that data supports selling, you have now run the protocol with today's verified numbers and seen the output. The data does not support selling. 0 signals have triggered. The on-chain structure is consistent with a drawdown in the late stages of a capitulation event, not a cycle top requiring exit. Go back to the comment you dropped at the beginning of this video. Here is what each answer reveals. The price. I cannot watch it go down anymore. This is loss aversion. The Kahneman mechanism. Your brain is responding to the gap between 126,000 and 60,000 as if it were a physical threat. This is the exact feeling that has caused every holder who sold at a prior bottom to sell at the bottom. The price level does not trigger any distribution signal. This is not a data-driven reason to sell. The liquidations. $1.1 billion in liquidations is a real frightening number, but it is a number that describes a mechanical clearing event, the forced closure of over-leveraged positions by automated exchange systems. It is not a number that describes institutional conviction holders exiting Bitcoin. Forced liquidations have preceded every major Bitcoin recovery in history. They are a feature of the bottom formation process, not evidence of permanent structural collapse. The jobs report. Higher than expected employment data increases the probability of prolonged higher rates. That is real macro pressure. It has also been present in some form at every major Bitcoin recovery. The 2023 recovery happened despite the highest interest rates in 15 years. Macro headwinds have never prevented Bitcoin from recovering when the on-chain structural signals were intact. They determine timing. The on-chain signals today are intact. The geopolitical escalation. Hezbollah rejecting the ceasefire is a real event with real risk implications. Bitcoin has recovered from every geopolitical shock in its 15-year history, including COVID, the Russia-Ukraine invasion, and prior Middle East escalations. Geopolitical risk creates volatility. It has never permanently impaired Bitcoin's long-term value trajectory. This is not a data-driven reason to sell the ETF outflows. The 11-day outflow streak is real and represents the longest in ETF history. But Bloomberg ETF analyst Eric Balchunas has consistently documented that large outflow clusters reflect portfolio-level rebalancing, not judgments about Bitcoin specifically. Total ETF balances remain at $82 billion, just 7% below their peak. Structural institutional ownership has not been materially unwound. The institutions that matter, Strategy, BlackRock, and the 38% institutional share of ETF assets, are accumulating, not distributing. This is not a data-driven reason to sell. There are exactly two types of Bitcoin holder who have made it through moments like this one in prior cycles. The first type is the holder who built their decision framework before the bloodbath arrived. This holder sat down during a period of relative calm and answered 3 questions in writing. What specific on-chain signals would justify selling? What percentage of my position am I committing to hold regardless of narrative or market events? And what is my protocol for checking whether those signals have triggered? When the bloodbath arrived, this holder did not make a decision under extreme psychological pressure. They ran their protocol, confirmed 0 triggers, and held. Not because they felt confident, because the framework they built in neutral conditions told them what to do in hostile ones. The second type is the holder making this decision right now, on June 5th, 2026, with a fear and greed index of $12 and $1.1 billion in liquidations as their primary inputs. This holder is making the most consequential financial decision of their recent life under conditions specifically designed by biology to produce the wrong answer. Every cognitive force is pointing toward selling, and every prior holder who followed those forces at a comparable moment walked away and watched the recovery happen without them. The Bitcoin holder's Bible is built for one purpose: to convert you from the second type of holder to the first type. Retroactively, even now, even in the middle of this, the regular retail price is $97. Because you stayed through this entire breakdown, use the code DIAMOND50 at the link below, all caps, DIAMOND50. That brings your price to $47. Let me put $47 in the only context that matters. The holder who exits at $60,200 today and re-enters at $90,000 after confirmation, if historical patterns from prior cycles repeat, will have given up approximately $30,000 per Bitcoin in foregone gains, plus the psychological cost of watching the recovery happen without them. The system that prevents that decision costs $47. Here is what the Bitcoin holder's Bible gives you: the complete on-chain signal framework, NUPL, MVRV, Z-score, RHODL, LTH SOPR, with the specific thresholds that define each signal's activation state, exactly as I walked through in today's protocol check. The check that produced 0 triggers, the check that says hold, the distribution ladder with 3 pre-committed signal-based exit rungs, the same framework that allowed holders who built their protocol in neutral conditions to distribute near $109,000 in September 2025, 14 days before the all-time high. The never sell core worksheet, the percentage of your position you commit to in writing in advance as the amount you hold regardless of price, narrative, or market events. The weekly protocol check, 5 minutes, 7 questions, 1 output, action or no action. And 6 composite holder profiles, including Sarah, who built the system in neutral conditions and distributed near the all-time high, and Marcus, who held with genuine conviction but sold at $64,000 in March 2026 without a signal because the accumulated psychological pressure became unbearable without a framework. Marcus is the story you are trying not to become. The code is DIAMOND50. The link is below and pinned in the comments. You watched a bloodbath this week. $1.8 billion in liquidations, 272,000 traders removed from the market by automated systems, a jobs report that crushed rate cut optimism, a geopolitical escalation that hit every risk asset simultaneously, and a 51% drawdown from an all-time high that felt this morning like it had no floor. And you stayed long enough to look at the data. Here is what the data says, clearly, without ambiguity, with every source verifiable in the links pinned below. 0 of 4 distribution signals have triggered. The MVRV Z-score at 0.41 is at 1/10 of the level that has historically preceded cycle tops. NUPL at 0.28 is at the boundary of the capitulation zone. LTH SOPR at 0.819 is approaching the confirmed bottom levels of 2018 and 2022. Long-term holder supply has increased by over 400,000 Bitcoin since February. Over $10 billion in short positions are stacked between current prices and $80,000, providing significant squeeze potential on any recovery. The cascade you watched was mechanical. Over-leveraged derivatives traders stacked on top of each other, triggered by converging macro catalysts, cleared by automated systems in 72 hours. That is not a signal about Bitcoin's fundamental value proposition. That is a signal that the derivatives market was fragile, and it is now substantially less fragile than it was on June 1st. Open Glassnode's free tier right now, find the NUPL chart, write down today's reading, find the MVRV Z-score, write down today's reading, date both numbers, June 5th, 2026, $60,200. Hold those numbers next to the reason you wrote in your comment at the beginning of this video. Ask yourself one question. Is my reason to sell supported by what I just wrote down, or by what I am feeling? If it is the data, the protocol tells you what to do. Run the 4 checks. None have triggered today. If it is the feeling, the exhaustion, the fear, the 51% drawdown, the 1.1 billion in liquidations, the jobs report, the headlines, you now have the complete historical record of what that feeling has produced for every holder who acted on it at every prior Bitcoin cycle bottom. Every single one of them regretted it. Subscribe. The next video in this series covers the 3 specific conditions that would actually justify selling, and what the Onchain structure will look like when those conditions are genuinely met. Because a system that only tells you to hold is not a complete system. A complete system tells you both when to hold and when to act. If this video gave you something concrete today, share it with one holder you know who is looking at the same screen you were looking at when you clicked on this video. Because today is exactly the kind of day when the gap between those two things costs holders the most. All data in this video was verified on June 5th, 2026, the day of production. Sources are listed in the pinned comment below. See you next time.